It is Saturday, September 29th. I'm going to do a video reviewing several markets here. There are a number of markets that are in important positions, and I thought I'd just review some charts and some indicators. This first chart is the S&P 500. This is a weekly chart, and there's a MACD study under here. This is, if you want to keep it simple, I think this is the most important chart from a technical perspective to watch. The price is at a new weekly high for this bull market since 2009. Broke out above the May 2012 high or April 2012 high. However, the MACD is at a lower high, so there's bearish divergence at this point. Now, there has not been a cross yet, but these type of signals need to be taken seriously. If you just look back at the past signals, at a strong bullish divergence down here on the weekly chart at the bear market low, you had a bearish divergence coming here into the sharp correction in 2010. You had a mild bearish divergence between here and here before the sharp correction in 2011 at the last bull market high. Had a bearish divergence, pretty sharp one. So these can lead to some significant highs, and I think the target at a minimum would be down below this point I have labeled D here, somewhere around the 1260 level in the S&P 500. Now, on a daily chart, you can look and see that there's a potential wedge type of pattern forming with a low in October 2011, a low in June 2012, creating a rising lower boundary, and then the 2011 and 2012 highs, which have just been exceeded and now closed back below. So that creates somewhat of a wedging type of pattern, which may be an ending pattern for the whole rally. And if that is the case, you're usually going to see a pretty dramatic decline off of that high. So these vertical lines represent the time up from the June low to the recent high here in September. Now, there may be another push to new highs, and if so, we could readjust the lines there. But let's just say that the high we've seen over the last couple weeks holds, and we're going to see a significant correction. We would probably see the market back below this 1266 level, that June low, in maybe half the time that advance took to form. So maybe within a couple months, maybe mid-November, we see the market back below those levels. So that would be a very reasonable expectation given how these type of patterns tend to complete. This is a monthly chart of the S&P 500, and there's a stochastics sell signal down here, and you can see there's a stochastic signal. It is currently above the 80 level, so it's overbought, but relative to the spring high in the S&P 500, again, we're at a lower high in the indicator, creating a type of bearish divergence. Again, we saw that signal happen as the market was peaking there in 2007. Similar type of thing happened here at the bull market high in 99 to 2000. So if this turns down here, let's say we get a down month in October, or even into October and November, we would probably get a cross on the monthly chart, and coming off a divergence and coming off of overbought, that could lead to at least a multi-month type of a corrective decline. So those are what to watch for the longer term. I think clearly the upside risk at this point from a technical perspective is, or the upside potential is probably limited compared to the downside potential. You're also looking at significant resistance from the 2000 and 2007 highs in the S&P 500. So if the market were to muster the strength to break out above there, then who knows, markets at new all-time highs can move much higher, but at this point in time, the technical setup is pretty clear that we should be looking for a top. This is a longer-term monthly chart of Apple, and I routinely show charts of Apple just because it is the leading stock in the market. It's the biggest stock in the world. It's the high flyer, and you got to look at these leading stocks to gauge what's happening in the market. And I've pointed out several times that I think that we should be looking for highs in Apple, and if you're in investment positions on it, obviously it's performed great for years and years and years, but you need to protect those gains. And right now, it is showing a potential danger sign as far as downside risk. This is a stochastic indicator down here, and on the last two swing highs, so the swing high from April on the monthly chart and the current high is showing a pretty significant bearish divergence on the stochastics. The last signals we saw somewhat similar to that were up in this region here on the stochastics and down in this area here between these swing lows here, obviously leading to some pretty substantial moves. These are monthly charts, so you saw a move on Apple from $38 down to $7 on that time frame there, so pretty large percentage move. So it has not crossed down yet, and this could continue to stay conjoined up in the overbought area for some time. That's possible. But given the divergence here, I think it's on alert that should support be broken, that would be a bearish signal. And I've already talked about this basing pattern that's happened in Apple over the last few months. At 620 was a cup with handle breakout point, and on successful patterns like that, the breakout point, once it's cleared like it has been, it should not be closed back below. If so, that's a sign that there's selling going on. That's a weak breakout, and you should use that as a selling point. So bottom line here, if Apple comes back down, closing below 620 on a weekly basis, my take is you got to get out of that stock. It's done. It's probably going to undergo a major correction or bear market type of a move. Now, to support that even further, on a monthly chart, we saw a doji candlestick here on the monthly chart. So this is a stock breaking out to new all-time highs. It just had a basing pattern. Is it really healthy to see a doji candlestick on the monthly chart right after a basing pattern? I don't think that it is, as far as for future advance of the stock. So it could just be a pause, and then the market could take off. So you don't necessarily have to short Apple here. You don't have to sell Apple here, but just understand that there are some signs here that the price could come down, and use that to get your stops under support, have clearly marked on your chart, have definite in your mind understanding of exactly when you're going to sell this, because stocks that have had such huge institutional sponsorship and they have so many funds holding them, once they make these significant highs, there's a lot of people that are going to have to unload those shares, and they can get pretty choppy and stagnant, and they may undergo major type of corrections for significant lengths of time. And the last thing I wanted to point out on this chart is just the volume pattern on the stock. This is a 12-period moving average. So this is a monthly chart. So 12 months is a year. So it doesn't really matter what time frame you use. You'll see the same thing. But I just chose that because it illustrates the point pretty clearly, and it's a logical time frame to use. And on a longer term basis, what we saw is from the 1997 low up to the tech bubble highs in the NASDAQ, we saw a nice volume expansion during that bull market run there as Apple rose. Then we saw the market volume decline as the stock finished its correction and made a basing period, and then we saw volume expand really largely, huge participation in that advance up into the 2007 highs. That's very healthy for a long-term pattern, for a long-term bull market. And then we saw this heavy sell-off in 2008, and then what we've seen is we've actually seen declining volume on the rise from 2009 here to 2012. So we've essentially seen a divergence in the volume pattern here. On a long-term chart, that's very significant. So if you're looking at a price move that's taken 15 years or a decade and a half, this is a very large degree. You'll usually see any subsequent wave or bull market have new volume peaks. So when you see a move of this degree not confirm on volume, you have less participation in the market. That's just a glaring divergence that that trend might be ending there. So there's a lot of factors here that suggest Apple's at risk, and I just think that people sometimes get caught up in these bellwether stocks and think that they're such a great company that the price can't go down, and obviously they are a good company, they have amazing products, but just look at the signs here and make sure you're protecting yourself if you're in these high flyers like Apple and Google. This is a weekly chart of gold prices. This is actually the GLD ETF, so it's not the continuous futures gold, but it's the gold ETF. And of significance this week, the commitment of traders data, so showing the large futures traders, shows that the commercial hedgers, so the smart money, has registered a major sell signal. So they're more heavily short, net short, than any time in the past year or so. So they're selling to a degree that's even higher than these last few price peaks here. So the price is encountering coming up to chart-based resistance here on the GL ETF at approximately 174-ish here on this prior high from February and March, and we're right underneath that now. The weekly stochastics is overbought, so I don't know that gold will necessarily top here. What I believe may be likely to happen, just from looking at the charts, is we may see a brief pullback and then a push to new highs over the next several weeks, and that would probably be the better topping signal here. That would allow let's click over to a daily chart. That would allow the daily chart to form some type of a stronger divergence on a move to slight new highs here. It might even be good to see the market slightly take out that high, so slightly exceed it, and then reverse back up below it if one was looking for a short position there. So in any case, gold's put in a very nice run since this breakout of this little triangle down here that I've showed before on there. So if anything, I would say if one is long gold, again, trail stops in gold. The smart money is heavily short here, and from a historical basis, there's a lot of contracts that could be sold here, so prices could have a lot of downside potential in them. So trail your stops if you're long. If you are looking to short gold, then I would wait for some slightly better divergence on the daily chart, and or possibly even just use the weekly time frame chart to initiate the trade signals on gold. This is a chart of USO, so the US oil ETF. So it roughly mirrors oil prices, and what we saw here is this very wide range down week last week, followed by some further downside this week, but a close in the upper half of the range there. The stochastics on a weekly time frame is overbought and is now turned down nicely into a sell signal. Price came up just below the upper Bollinger Band on the advance, and the advance was not as sharp as this decline here. So this creates a relatively nice short trade setup on oil. My only issue here with looking to short oil currently is there's not a weekly time frame divergence, but there's enough confirmation from other markets that this could be a successful short selling opportunity that you can at least keep it on the radar. The daily MACD put in a nice divergence, bearish divergence on this peak here, and has crossed into a sell signal. So what may happen here, it looks like it's kind of running down out of steam on this initial move down here. We may see some consolidation or retracement back up towards this gap level, and then if you see the daily stochastics cycle back up, let's see if we got that here. Well, if you see the daily stochastic cycle back up to overbought after some consolidation, that may be an ideal time to look at a short opportunity for another move down, breaking those lows there. This is the OIH, so Oil Service Holders ETF, and there's this really strong bearish divergence on the MACD at this recent high, and it's also below resistance from these highs over the last year or so. Again, this, if one is short, this is a very classic and nice solid short sell signal. So this would be the stop loss point for any type of energy complex or stock short positions. So you can also look at the XLE ETF, but those ETFs are ways to short a broad basket of stocks related to the oil industry. This is the chart of TLT, which is a long-term bond ETF, and bonds are an interesting position. I've talked about them several times on the blogs over the last few months, anticipating a major high in the bonds, and I just don't know if we're going to see that at this point. We got a nice bearish divergence on between the highs from 2011 to the highs this year in 2012 on this MACD. Then we got a cross down on the weekly chart. We had a ending diagonal or wedging type of pattern there. On the initial sell-off, the price came down and tested that lower boundary and had a slight rebound. I'll click over to a daily chart so we can see that better. So it tested this uptrend line, had a rebound, and then came down and broke through that trend line with a gap down. However, the price has come back and not only back tested that trend line from the underside, it's actually closed back above it. And the daily MACD chart has had somewhat of a bullish divergence there and has crossed back up into a buy signal. So as far as for shorts on bonds, that doesn't look really constructive, but it's something to keep on the radar. As far as the logic here on this, from this high here down to this low here, took that long, and we've seen the market only partially retrace that move down in that amount of time. So this may just be a corrective move before the next sharp move down. So what I would look for on this is I would look at the daily stochastics chart or the hourly chart. So I'll click over to the hourly chart of TLT here, and I would watch the hourly MACD and the daily stochastics if looking to go shorter inverse bonds there. And what we see is currently the MACD made a high, but there's not really been a nice divergence for shorting. So what we'd probably want to look at is look for a new price move high with the MACD making a lower high, and then look for the MACD to cross back down again, and that would give a short signal with a stop to cover above that above that level, and then you could monitor the trade with the technical indicators and take what the market gives you if the short position works out. Now, moving back to the stock market, this is a chart of the commitment of traders data, and it's showing the difference between the commercial, so smart money holdings, and then the large speculator holdings, and the spread between them. So whenever this line is very high, that shows that smart money is very net long, or they're buying, anticipating a market rally. And whenever this line is very low, below the center zero line, that means they're heavily net short, expecting the market to decline. And as of the current reporting period, they are at a new 3-year low, so they're very heavily net short, more so than they were in May of 2011, more so than they were in April of 2012. And so I just want to take you back and kind of give you a realistic expectation of what the market may do here, based off of what it's done in the past times when the spread has gotten this large. In May of 2011, we saw approximate 20% correction in the S&P 500. After that, in June of 2009, this was at the end of the first leg up of the new bull market, prices peaked and underwent about an 8% correction in about 4 weeks into July. Then in the end of 2008 into New Year's 2009, the market underwent about a 25 to 30% correction into its final bear market low in March. Obviously, we are probably not set for that type of price velocity move down just yet because the market's still in an uptrend. But in any case, it's a significant decline there. And then prior to that, in early 2007, as the market was continuing a tight trend between October and February, October 2006 to February 2007, on the last couple of days of February and into early March, the market underwent kind of a very large one-day 4% correction, I believe February 28th or 27th of 2007, and underwent about a 3-week 8% correction there, even in the midst of that bull market there. So even in the times where we've been in the midst of a bull market, we've seen about 8% corrections. The last times the spread has gotten this wide. In a bear market, the last time we saw this, was in the early October 2008, right before a major price plunge, and then again in the New Year 2009 before the final plunge to lows there. So I think that this is an indication that we need to lock up on any type of long positions. You need to protect growth stocks. You need to consider just kind of exiting the stock market on an investment basis, and on a trading basis, look for some maybe longer time frame short positions there, if you have experience doing that and you've thought that out pretty well. And the last thing I'm going to show in this video is a quick run through of a few of the sectors, and in case that's of use to anybody or you're tracking specific sectors or specific stocks. This is XLE, so this is the energy sector ETF, and this is a daily chart. We saw this month price break above the earlier year high and then immediately reverse back below it. And however, that move down has been less explosive, less fast than this breakout above it. So because of that, I don't think the psychology has really shifted to a downward phase here. So I think what we might see and what might be a reasonable trade setup is, see the market kind of continue down in a less explosive fashion, and then put in some type of a rebound, and then if the price then comes down and breaks that support level at that point, that would provide a short entry. So you could short on a break to new lows if we see that type of a setup with a stop above those highs there. So in any case, just that's my expectation of what may happen here, as far as waiting for this pattern to pan out and when would be the best time to actually expect an acceleration down in the energy stocks. This is a weekly chart of XLF, so this is the financials, and financials can tend to be a leading type of a sector, so I always watch that closely. And what we can see with them is they never did break above their 2012 high, so there's a non-confirmation between financials and the broad market, which is one side of weakness. The financials, the MACD is making a currently bearish divergence on the breakout above the 2012 highs, and that breakout has already failed. So it broke out with a big bar there, formed an inside bar, and then has closed lower and taken out the low of the prior bars. So just from a bar chart analysis there, that could be a sell signal already in effect there, but you could use some type of weekly technical indicator to get some more confirmation of a top there. But I would consider the financials a leading downside sector, and just to understand how these signals work, if you go back through some of these signals here, the MACD had a weekly divergence between these highs here, and price broke out above those highs, but the MACD was at a lower high, and then we saw price on this bar come back down below the old highs, and then we soon saw the MACD actually cross down, and while it didn't lead to a huge correction at that point in time, we did see the market continue to correct and consolidate. A good time to be on the sidelines or out of those particular stock sectors. Similar thing happened here. We saw a breakout attempt above this 2010 high, which immediately closed back below that. It took a week or two for the MACD to enter a sell signal, and then we saw significant correction. So we're really seeing that again here. We're seeing a breakout attempt above an old high, so we have some chart resistance there. That breakout has currently failed. So if we see the MACD actually cross down there, that would be a signal to exit the financial sector, and there may be some significant downside ahead at that point in time. This is a chart of XLV, so the healthcare sector, and with the election going on, a lot of talk about healthcare and hopes and fears of what's going to happen there. I think this is an interesting sector to watch from a kind of a sociological standpoint here, but this looks like a pretty clear time to exit health-related stocks. Whenever you see this type of a pattern, it just doesn't get much better for selling than this. What we've seen is since the 2009 low, a distinct high in 2010, a distinct high in 2011, and now price has come back up and it's touched that upper boundary line. The weekly RSI is overbought, and in the current weekly time frame, we had somewhat of a reversal bar closing in the lower end of the range as it hit that resistance there. You're not always going to be able to pick tops perfectly or bottoms perfectly in markets, but whenever you have a channel like this and you see some distinct weekly highs, when you see the market push up into that resistance line, that's a great time to unload your position there. So just thought that was an interesting chart to look at, and if you're long any healthcare stocks, then take a look at those and get an exit plan in order. Have your stops being trailed there, so if the market does show any weakness, you're getting taken out of those stocks there. And this is a chart of XHB, so this is the Home Builders Index, and housing stocks for a change have actually been one of the big leaders in this last run-up in the market, so that they've made about 100% advance since last year at this time, so they've made some pretty big gains. This is one sector that actually there is no bearish divergence at this high, so I don't know if it's actually ready to top yet. Maybe it needs to come down a bit and then make another attempt to break out, create some stronger divergence before it actually puts in a significant high. But one thing of note here, this line represents some chart resistance. So if you go back to the after the housing bubble in 2005, 2006, we saw this major downside in the markets, and then in 2008 the market attempted to rebound and twice came up to this level around the 25 level on XHB, and then obviously failed at that level and went to new market lows. So we're back having crossed that level now, but the market has put in a swing high and has come back down just right to those levels there. So this will be an interesting level to watch, and if the market does close back below that level and we see the MACD cross down, that would be a warning signal that we may be seeing a top in place. If looking to possibly short that sector, you may want to wait for this uptrend line to be broken and then look for some type of a minor rebound before shorting there. The last chart I'll show is this is a XPH, which is a pharmaceutical sector ETF, and it's had some divergence between the most recent highs on the daily chart. Let me click over to a weekly chart here, and some pretty strong divergence on the weekly chart, almost a three push type of pattern. So we saw the MACD reach its peak at these highs, come down a swing low, and it pushed to newer highs with a lower MACD, cross down, make a swing low, and then it pushed to newer highs with yet a lower high in the MACD. So this is a pretty strong divergence on even a weekly time frame on this sector. And if you look at the setup here, price is hovering just below an established trend line in that ETF right there. So if the price comes down below that trend line, especially if there's a gap down below that trend line, that might be kind of the nail in the coffin as far as this particular run up in the markets. We may see a significant correction of that sector there. So hope that update is helpful there. I think the smartest thing to do here is either be in the sidelines for most investments. Look to be long the U.S. dollar on an investment basis, and if you're in growth stocks, trail your stocks there, because it's pretty well established that about 70 or 80% of stocks are going to track the broad market. So the broad market looks set to correct here. Most of the sectors look like they're going to be entering corrections. So the stocks that are going to hold up are going to be few and far between, even the great ones like Apple. So have your exit plan very well set. Have it definite and precise in your mind as far as exactly what level is the time you need to sell if you're currently in positions, and be patiently wait for the correct short sale signals with some objective indicators if you're looking to short these sectors, and make sure that as you're managing those trades that you have an exit strategy in mind and you're following indicators, so you take what the market gives you and not get caught up waiting for a move that never happens and turn a potentially good trade into a loss. Have a great weekend.